Hello everyone. In this video, let's do a quick overview of Chapter 13, Current Liabilities. As we finished the Chapter 12, Investments, so we finished discussion for all of the asset items on the balance sheet, or the left side of your accounting equation. Now let's look for the resources. When a business tries to acquire any type of assets, it only can come from two different resources. From the owner or the return earnings the company has earned, or is coming as a type of debt, like you borrow the fund or unpaid for the purchase or the bills. So the right side of the accounting equation tells the users a distribution of the company's assets, right? We need to maintain a reasonable or safe distribution between liabilities and shareholders' equity. For liabilities, we break down into current and non-current depending on the payment period. This is the same period classification as current assets and non-current. If a liability need a payment in a calendar year, like last one calendar year or one operational cycle, which one is longer? Okay, be careful. Most companies use calendar year, like 12 months, or very rarely they use their operational cycles. So compare the calendar year and the operational cycle, which one is longer? Then anything paid within, this 1 year or one operational cycle is current. So in near-term payments. So it helps the users assess the risk of a short-term data payments. Anything beyond 1 year, that's long-term. So long-term risk of data payments. In Chapter 13, we focus on current, different liabilities under the current category, and 14, we discuss the bonds payable, long-term notes payable, so the long-term liabilities. Then 15, so Chapter 15, 16, and 17, those are three specific liabilities: leasing, pension, and income tax payable. Again, we have no time to cover those three items in intermediate two. So that will be discussed in the third class related to this book. So moving to current liabilities, based upon the categories separated in the book, so I have a summary map, so in this chapter, we focus on the different types of current liabilities. We need to understand so what type of business transactions evoke these different items. And when those transactions incurred in your business operations, how we can analyze them and record them in the appropriate journal entries. So that's kind of the focus of this chapter. So for example, the first group in the book, they call open accounts payables and the trading notes payables. So so these two types of current liabilities are generated if the company have unpaid purchases, right? So if you purchase the inventory or if you incurred expenses, so you haven't made the payments. So accounts payables or open accounts payables or trading notes payables. The trading notes payables, normally you have a formal legal contract. So rather than just supported by a invoice only. So trading notes payables, you have more like legal binding to make the payment. And the payment term can be longer than accounts payable. So accounts payable is the normal like invoice and a short term, a very short like 30, 45 maximum 6 days, okay, supported by the good credit by the, the purchasing company. And so that's also the common accounts payables, okay, we talk about it from the prior, classes. Then the short-term notes payable, so this one is different from the trading notes payables. The short-term notes payables normally are related to a direct borrowing from a financial institution, or maybe you borrow from another business. So not really related to purchasing or bills, is only a direct financing for a short-term cash needs. And for this one is interest bearing, right? Direct interest bearing or non-interest bearing. Okay, but still short term. So checking the transactions related to interest bearing notes, like for example, when you sign a note and then accrued interest, like by the year end, if the notes go over one accounting period. And then the transaction related to payment of the notes and also the payment of the interest upon the maturity time. Okay, so the book has examples. So signing the notes, accrue interest, and make payments upon the maturity time. And for non-interest bearing notes, we have similar situations. Signing the notes, related to the interest and the final payments. So I copied a slide, okay, related to the transactions. So again, from my point, I give you the study approach, but I expect you to develop details like the transactions for each type of current liabilities to give a summary like this. For example, the non-interest bearing, I have an example. So May 1st, the technology firm bought inventory worth 658,000, okay, by issuing a 700,000 non-interest bearing notes. So this can be also like probably like a trading notes payable, right? But it's related to a purchase, but the non-interest bearing. But it should have the same accounting treatment. Oh, it doesn't matter the reason for us to have the non-interest notes payable. So the non-interest notes payable, because the interest is not directly printed on the face of the notes. So when you sign the notes for the purchase or the borrowing, so you see the journal entry like May 1st, we recognize, so you buy the inventory. Okay, the cost of the inventory is discounted. Face values are like not really the face value of the note, like or the maturity value of the note, which is 700. So the notes payable is 700,000, and then we recognize a discounted note. I think this belief is assuming you have some source of the interest. So I will put the interest later, but there is a 42,000 total interest involved with the note. And the difference is the cost for the inventory. For non-interest bearing notes, we had a similar example in chapter 10 when you acquire a long-term assets using a non-interest bearing notes. So this is very similar, but we only have, the only difference is the notes payable here is a short term, so rather than long term. Okay, so but we have the same idea for we use the discount on notes in the beginning to recognize all of the interest involved in the notes. So the cost of the inventory, be careful, is different from the face value of the notes. Then on November 1st, okay, that's the time when the the maturity time of the notes when the note is due. So first, you recognize the interest expense and reduce all of the discount. Because in the beginning, because of the accrual basis, we couldn't put the interest expense yet. Okay, so we have to use a intermediary account for discount on the notes payable to represent the total interest. But by the maturity time, so we convert all of the discount into the interest expense and then make a payment for the face value of the note. So that be the notes payable and credit cash. So that's the transaction analysis and the journal entry related to the notes payable, but for the non-interest bearing case. Okay, so for when you study by yourself, okay, try to, when you read the ebook, go over the slides. So give examples, so make your own notes. Expand this study map to give the transaction and the journal entries. Okay, just showing you one example of how I proceed, how I can use this map to help your own study. So then similarly, we have three more current liabilities. And the next big group is they call accrued expenses or accrued liabilities. So in this group, we have so common items included for under this group of interest payables. That's related to the notes payable, so interest bearing or non-interest bearing. Okay, both cases. Because interest is normally paid after, so accrue first, then paid later. So accrued expense means we have expense, we recognize expense before we make the cash payment. So it's delayed payments. So recognize expense early than cash payments. Then the whole salary, compensation related, commissions and bonuses. Recognize salary compensation expense before we make the payments. So that's another common item under the accrued expense. So depending on your payroll or compensated vacations or sick leaves or the bonus, okay, overall is accrued expense. So check more details in the book or in the slide for examples. Income tax payable is also an accrued expense, but more details, we have one special chapter talking about the tax-related debt or deferred tax pay assets. Okay, so it's on chapter 16. So find examples for the accrued expense categories. Then we have the liabilities related to advanced collection from customers, like customer deposits or unearned revenues, right? So if you have collected cash related to rent, subscriptions, or insurance or down payments. So we collect cash before we deliver the products or provide a service to customers. So that's represent, so when you receive the cash, it represent a unearned, so liability from the customers. Okay, that's a general group of unearned revenues. And a new situations is all of the gift card sales. So if the retailer wholesale, right, so when you sell gift card to our customers, we all, I think, have purchased the gift card or received the gift card, right, from a consumer perspective. But if you are the company selling gift card, it's not a revenue yet. So when you sell the gift card, like $100, $50, when we collect the cash from a gift card sale, we cannot recognize as revenue yet because that's not the time the customer use the gift card to purchase. So we have to put on a gift card liability. something similar to unearned revenue. But this one, you really have no idea of when the consumer will bring the gift card, make the purchase. So the uncertainty of the use of the gift card is more uncertain than the unearned revenues, right? For the unearned revenue, we know the rent, that collection of the rent is for 6 months, a year, or insurance. So the gift card liability, recognizing so when you convert the gift card liability into revenue, is based upon your past gift card sales experience, also on the consumer behavior. Okay, so it's more discretionary. Recognize the revenue is more discretionary, judgmental than the unearned revenue categories. And finally, if you help, like sometimes we collect the cash, like the sales tax. So you collect the sales tax from customer for the government, right? So when we collect this city, local sales tax or state, so it's only stay in the company very shortly before you remit it back to the government, right? So those part, like the 8% of your sales revenue as sales tax, is not your own revenue. We